In partnership with Kura KiwiSaver, the Everyday Investor is proud to present News of the Money World, an informative, informal, yet hopefully entertaining look into all the latest happenings in the wonderful yet overly complicated world of finance. Take a look at the world through the eyes of the markets. As usual, all content is provided on the basis of listener beware. Our views are often our own and definitely shouldn't be relied on for any investment decision. Let's get started. That's what they said. Hey everyone, welcome to News of the Money World, episode 71. How are you, Rupert Carline?
I'm very good. How are you, Darcy? Do you have a good long weekend?
Really good long weekend. It could just keep on going as far as I'm concerned, and so much so to the point that we just didn't even have time yesterday to catch up. So forgive us, everyone, for the slight delays in bringing this one to you.
Yeah.
We're going to talk about NVIDIA, AI, the SEC crackdown on crypto, and then if we can, we're going to bring it all back down to New Zealand here again. So let's start with NVIDIA and the tech boom that seems to be just going off. Like if you could just strip out all the dead weight from the S&P 500, you're basically left with a giant tech fund. And that probably would have been the way to go, right? If only we would have known, eh?
Oh, if only we would have known, right? I mean,
yeah,
it's been a really interesting year. I'm just trying to pull up some numbers, but of course can't find them. I mean, NASDAQ up kind of 25% year to date, and it's been some amazing stuff that's happened. I mean, that's a combination of, again, things were a little bit beaten up last year, but this AI boom is really just going to transform tech companies, transform how we do everything. And over the last month to 6 weeks, we're starting to see some real insights as to kind of actually how we're going to make it real, right? It's gone from being the 99 internet promise to probably over really quickly in the last 3 months to going, hold on a sec, we're now into the 2007 social media promise, which actually turned into something massive.
I think most people by now probably would have played around a little bit with, say, ChatGPT. Some of us have probably gone a little bit further with the images, with the videos now that can be created simply by putting in voice prompts. And when you unleash a bunch of data onto some of these platforms, you can start to see things that you couldn't actually even see before. So I just wonder, like, when it starts to get a hold of our Microsoft 365 license and it starts to crawl around in Word, in Excel, in your inbox, that's going to unlock a ton of productivity. So just on the positive side of the spectrum, that ultimately leads to higher profits, basically, from less operating costs. That's at a micro level, but is that kind of the thing that's going on right now with some of these firms that are starting to use it, or are they kind of foreseeing that or anticipating that?
People haven't quite gone that far yet, to be perfectly honest. And I think people are being far more direct and far more blunt about it. So little things, right? We have NVIDIA. NVIDIA released results week before last. And they're the Q1 results, and they just absolutely smashed the lights out. Revenue expectations for the next quarter are 50% higher than where the street had previously expected them to be. And they're pretty clear on the reasoning for it, right? They're now making chips for $10,000 that used to sell for a couple of $100. And it's just absolutely amazing on what they've been able to do. They spent their kind of the Q1 earnings call. They're talking about actually the next thing for them is they've got chips that are going to be allowed that can create avatars. So when you're gaming, you've got an avatar that's going to kind of be coming through this journey with you. And I think it's truly, truly, truly amazing what's happening. I personally don't understand it. There's a difference between GPUs and NPUs and all of this tech mumbo jumbo. But apparently they've kind of so far ahead of the game because what they've managed to do is they've created these chips that effectively way faster at processing information. And that's what AI is all about. It's all about how fast can you process information, massive amounts of data, to come up with coherent streams and coherent information. And clearly NVIDIA from a chip perspective are at the top of the game right now, which is why they've kind of, their share price has almost tripled this year. And they are likely to be one of only kind of a handful of $1 trillion companies. But NVIDIA itself is up 3 times.
Yeah, wow.
300%. And that's because of this new kind of boom and this new set of products, right? But NVIDIA is not alone. You're also seeing this in Microsoft and Amazon and Apple. the whole tech universe is kind of jumping on the bandwagon of this amazing kind of AI boom. And
It's
I
like they're
think
getting retooled, aren't they?
well, exactly, right? So you look at Microsoft clearly in a great position with their partnership with ChatGPT. Analysts are now saying they expect AI to deliver a kind of 20 to 30% earnings bump over the next 5 years. That's amazing when you think about one of the largest companies in the world that can sit there and go, here's a new product segment that we're about to get into that's going to deliver 20 to 30% of extra growth. And that's going to be driven by little things, right? So at the moment, one of the examples that they give is they're using AI and GitHub. So GitHub, the tool that all the developers use to kind of manage the deployment of new software or new lines of code. And now for $10 a month, you can get $10 extra a month. You can have an AI do reviews of the code for you to help you reduce errors, minimize things. We're about to see Office 365. That we're about to get a whole series of options to kind of help us in editing, reviewing, working on our work. And that's not going to be free, unfortunately. It's all going to come for an extra $5 or $10 a month. And I think it's just, so that's kind of another great example. Google, they flopped in their first Outlook with Bard, but kind of the second kind of release seemed to be a whole lot better. And you just think about the potential of what AI can do to their global advertising business. And it's kind of, I think that's where everyone just gets really, really excited about how this goes to the next level.
So I wonder where this goes, just zooming out a little bit and thinking about this more on a longer time frame. Technology induced deflation, and
Yep.
that's kind of the track that we were on before this pandemic hit. Is prices were generally getting cheaper and cheaper and cheaper, and it seems like no matter what was happening, inflation could never really be invoked. And I can kind of understand that when you have the marginal cost of production, or the cost of producing one extra unit actually decreases over time, especially when you have technological leaps like this and you're already involved in digital type businesses. If we can reduce our costs, like you're in a fund manager seat, I'm in a financial advisor's seat, both of us can benefit from reduced costs to do our work, which means that effectively we can lower our fees, our cost of production get lower, and our profit can be maintained. But that's probably a temporary thing until competition forces bring that down. Effectively, you get conglomeration, concentration of power. Where do you think this all goes, Rupert?
Oh, look, I think it drives the next layer of efficiency, right? So if we think about the last 30 years, whether it be the internet, I mean, just think about how much more efficient the internet has made everyone in the finance accounting world, Microsoft Office and Microsoft Excel, what that's managed to do to everyone. So there is I agree with you. I think this drives the next layer and the next step of productivity. I think the big question on everyone's mind is how much does this cost? And who pays for it all, right? And that's why for me at the moment, I kind of go, so for my business, yeah, I know we need to do it. I know we need to spend a whole lot of time on it. But I think that in the short term, there's actually going to be a cost increase as we kind of resource up to understand how to use it and how to do it properly before we can then kind of get through the other side of it. And then the other problem that you end up with is you end up in a world where everyone goes, well, actually, everyone's doing an amazing job. Everyone's lifting the bar so significantly. And so you don't actually end up doing the same thing, right? So I think about when I very first started my career, Excel models were kind of a lot more basic, a lot more simple, because fundamentally you didn't have the power to build everything that you can do today. So as the tools evolve and as things get better, people end up making the jobs a whole lot better and more sophisticated.
Yeah.
One of the things that I do firmly believe here, and this is where it's going to get really interesting as well, I think the big winners in AI are going to be the big boys. And I think and that's potentially the downside to a lot of the disinflationary impacts, because what you see with AI is it requires huge data sets. And if you think about it, that the big tech companies have got humongous data sets that they're able to leverage and use. And it requires a huge amount of processing power. And as we've talked about, processing power is not cheap. You got to buy a lot of those $10,000 NVIDIA chips. you've got to buy a huge amount of a lot of different things, and a lot of energy. So whether that be a lot of space in Azure, AWS, wherever. I personally, I think, unfortunately, what we're starting to see is, I think that this could lead to the second kind of conglomeration of power inside those top kind of 5 or 6 companies. It's going to be really hard to see how anyone kind of breaks their stranglehold, because they don't have access to the data and they don't have deep enough pockets to focus on the engineering talent, or just simply fund the processing power that needs to happen.
Yeah. Okay. Complete different tangent here. We didn't talk about or agree to talk about this, but I just want to know, because it's something that I've been chewing on since an interview I had with another guest that'll come out next Monday around ESG, environmental, social, and governance principles.
Yeah.
Just on that topic of concentration of power,
Yep.
centralization, that sort of thing. Surely more power consumption to generate more computational power to power this new world, this new AI world, where we'll put on our Apple glasses and we're now transported into this other dimension and we've completely disconnected from the reality we once knew. Surely that's going to contain some risks. And from an investor's perspective who does want to put an overlay of responsible investing over what they do you think this is going to cause some issues as these companies get bigger and bigger and bigger and more powerful, so much so to the point that they start writing their own rules? And I don't know if ESG will feature. Do you think that we got a risk there?
Oh, look, there's a massive risk. And we've already seen, I mean, to be fair, we've already seen it with Facebook, where Facebook is seen from a ESG perspective. So the social side of as Facebook makes it uninvestable for a lot of sustainable investors, including ourselves. And I think I see that only getting worse, unfortunately. You come back to what I was talking about with Google, the power that they will have on their search and on their advertising platforms, Microsoft. And so I see one of the risks that we move to is people live in a much more closed ecosystem, because AI is the thing that's going to go out and fetch all the information and fetch everything from you, right? I mean, you look at yesterday where Apple launched their new glasses. And again, where they're expecting people to spend their lives with glasses on now, living in an augmented reality world. And you kind of go, that's pretty scary. From now on, you're basically going to live in a world where Apple kind of sees it. So I do think ESG investors will have a role to play here. Unfortunately, I think it's probably politicians, and we know how great politicians are at actually making change and making decisions. But politicians are going to have to make a big impact as well on what happens. So I'm a little bit nervous about where this all goes, but it's going to be fascinating to see. And as an investor, we're going to have to be pretty careful and go, at what point do we start calling companies out for poor performance and for what we believe are antisocial activities, versus continuing to chase the profits?
Yeah, I could talk all day on that one. That's a good one. Okay, but let's go now to another big player on the block, the SEC, the Securities and Exchange Commission. They've been busy. Gary Gensler is the head of this crowd, you could say. He's the team leader, and recently come out and they're basically going after crypto. And it's not like this is the beginning of it. This is just the latest of what I would consider a strategic set of events designed to take down this ecosystem as much as they possibly can before the introduction of a central bank issued digital currency, which sounds really fringe now, but in 6 months, I don't think it will be. So I'll say it anyway. But what's going on right now with the SEC? They're going after Binance. They're going after Coinbase. We both listen to a great podcast called Odd Lots. We talk about this from time to time. And Matt Levine, one of the hosts of that show, basically he has a piece here where he's talking about the fact that they've come after it and almost taking the side with the regulators here, saying that almost implying that they are peddling illegal securities and potentially stealing your money. So let's talk about that. Are they operating like is Binance and is Coinbase, are they operating an illegal securities exchange in the US in your view?
Yes.
Why?
And we've talked about this a little bit in the past. My view is lots of what they offer are financial products. Fundamentally, you buy a number of the coins you buy on the expectation of a financial return. And that's because they might be funding a project which is expected to pump out dividends, whether that be Solana or other things. Or alternatively, you're buying derivatives that are associated with cryptocurrency assets. And so, to my mind, a lot of what they have been offering for a very long time have been securities. And I think one of the things is one of the definitions that I kind of read about this morning about it, whether it sits in the SEC remit, is if investors buy into a fund or a company or a project with the intention of profiting from those efforts, then that is what the US courts have determined is a security. And I would argue, I think they've only nominated $120 billion of the crypto ecosystem to be securities. I'd argue they probably could have even done more than that. And I think, to me, for a long time, crypto has sat outside of the regulatory world. And they've kind of almost been but I've never really understood why they have. And so, to me, I would argue that actually this isn't kind of altogether, this should not have been completely unexpected. And I mean, I think this is a good thing as well, right? Because they've also taken very different actions against both Coinbase and the SEC. Coinbase and Binance. Coinbase is saying, hey, look, there's an issue. It's going to result in a fine, but we can probably work our way through this and figure out how you can operate to comply with the rules. Binance, they're clearly just throwing the book at, right? Binance, they're saying they're kind of sending in receivers. They're trying to liquidate the whole business. And so I think that's a slightly uglier scenario. But in my mind, I don't see it as being, I'm not entirely surprised, and I think it's potentially overdue.
Yeah, okay. I just want to share this one here if I can. This is a tweet from Brian Armstrong, who heads up Coinbase, regarding the SEC complaint today. And this is something interesting that I think we're seeing this come out of CZ from Binance as well, that they're effectively proud to represent the industry in court. In other words, what they're saying is they accept it. They're accepting it with humility, but at the same time, they also recognize the fact that this is probably a battle that needs to take place in the courts, because there was no come in and register situation going on. And they tried to deal with the SEC when they formed their company. And there's been conflicting statements out of the SEC and the CFTC. Now they're coming after them via regulation via enforcement. And so, like, I get concerned about that, because it kind of makes me feel like clearly this has been a new area. It's been developing at speed, and it's caught a lot of people off guard, regulators especially, who are always operating 10 steps behind, ambulance at the bottom of the cliff. So it's understandable that it's happened, but the rate of change is happening so fast in the evolution of tomorrow's financial system that it's inevitable that this is going to happen. But we can't keep on going after those who are innovating and slamming them with regulations. They are causing harm. Hey, welcome to the free market. That's kind of what happens. It's creative destruction everywhere. And we're going to be losing from regulators, or we're going to be losing from these new financial institutions. But I saw a poll that I think CZ put out around who do you trust more, the SEC or Binance? Obviously, it's slightly tilted in his favor just being on Twitter. 85% said I would actually trust Binance over the SEC. And that's taking into consideration that there's still question marks around how they're operating. So yeah, I've just been babbling on there, but what are your thoughts on that, Rupert?
I think there's a couple of points there, right? So it's so frustrating. And I understand why Coinbase and the CZ are extremely frustrated, because the regulator says effectively, go ahead, give it a go. If we like it, great, you'll never hear from us again. If you don't like us, if we don't like it, then we might come and talk to you. And so what that means is kind of makes it really hard to create certainty for a business case. But the flip side to that is the Coinbase business might have spent 3 years battling the SEC and having a conversation with the SEC before they then turned around and said yes. And so I think that's the dichotomy that we've got to play with, right? Regulators do not move fast, and we kind of know that. And I think that's the real issue. Whereas, do you want them slowing everything down so we get a whole lot less innovation, or do you want them kind of coming in afterwards and making a decision? And you have to kind of, I think it's hard to argue the fact that crypto has not done itself a huge number of favors. There have been way too many meltdowns, way too much stuff has gone wrong, and that is now why they're acting. I get from a Coinbase perspective, from a Binance perspective, that's not necessarily them, and that's not their fault. But as we always know, it's always the bad actors that take down the whole industry. And so I don't know what the right answer is here. I feel extremely sorry for Coinbase. I feel sorry for Binance. But it is hard. I mean, actually, I feel Binance. I feel a little bit less kind of sorry for. Right, similar to what was happening with FTX, big derivatives business targeting US customers, but done through offshore subsidiaries and claiming, well, we never targeted them, so it's not our fault. To me, that doesn't really wash. Some of the AML failings, again, that's kind of bread and butter. So I think, yeah, it's a really hard one from my perspective. One of the articles that I read was talking about it's frustrated the hell out of the established kind of traditional securities exchanges over the last 3 or 4 years that they have to go through this rigmarole, and they have this highly compliant world. But just because it's classed as a crypto, why do the others not? And I don't have a good reason for that either.
Yeah. Why should we have to subscribe to a much higher standard just because we're putting ourselves out there in the traditional world? We're doing everything by the book, yet these innovators over here, they seem like they're doing something really similar to us, but they're getting away with it and they just keep going. So I kind of get that as well. Actually, it's really important to say here, like crypto is not Bitcoin. Bitcoin has been carved out. It's not necessarily a security, according to the SEC. From what I can understand, from what I've been reading, seems like it's consistently been carved out of the equation. I wonder if there's a question mark on Ethereum, but effectively what they're saying is that almost every other token out there's a very compelling case that maybe that is actually a security. That's my understanding of it so far. Of course, I'm still trying to understand it. But Bitcoin has been one of the best performing assets this year. And while it did take a hit, it rebounded, I think, by like 5% yesterday. So, yeah. Any thoughts on that one?
Well, I think it is really interesting, right? I found it fascinating that Solana was listed as a security, but Ethereum was not, or Ether was not. So, and I think it's also, there's some dichotomies in there that I don't understand, right? So if you're going to sit there and say, so Binance, so sorry, Bitcoin is not a security, yet Binance coin is a security. There's a bit of stuff, and so kind of stable coins do seem to be caught up in some of it. So look, I don't really know or understand exactly kind of where those lines are being drawn. I don't think anyone probably does. But to be honest, and unfortunately, it's going to take a while to get there. But court, the only place where this is going to get resolved is in court. And hopefully that allows us to have some pretty clear definitions around what is a security, how does something, and what are the rules around what you need to do if it is a security. Because at the moment, that clarity is not there.
Yeah. Okay. Cool. All right. And so I want to maybe just shift our discussion a little bit. You sent me an article beforehand. I can't bring it up on the screen. Sorry, Rupert, but the article was like a really good report. If I can, I'll put the link into the show notes. But you're talking a lot around the views on investors at the moment. So can you just start by telling us a little bit about that piece that you've put out recently and what your views are on investors and behaviors at the moment?
Yeah. So look, the last 2 years or 3 years, sorry, it's been an amazing time to be in.
He gone. Sorry about this, folks. I'm not quite sure where Rupert's gone, but he's frozen. He's frozen in time. Computer ran out of battery. So I just got a text from Rupert saying his computer ran out of battery. So we'll just wait for him to join us again here. But while we're waiting, hey everyone, please excuse the interruption. And no, this is not an ad. This is a special announcement. And no, I'm not pregnant. Now, I'm going to take advantage of the fact that Rupert had a malfunction in his recording thing on his end. So I'm going to bring you an announcement to let you know what's going on with news of the money world over the next little while. And by the way, I'm battling a really nasty virus, so forgive me for the extra sexy radio announcing voice. It is temporary. Well, that's temporary. It's not temporary. The realization that's dawning on me that over the last probably couple of months in particular, I'm probably in a season where it's necessary for more focus, more hard work, and potentially some bigger moves coming up. My suspicion is that this sort of reevaluation thing is probably playing out a lot in the lives of people that I work with and also especially those that are involved in business. My core business revolves around providing financial advice. I'm a financial advisor. I specialize in mortgages, helping people through property transactions, KiwiSaver, and providing financial strategy for individuals and for families. About 90% of what I do on these podcasts are all to do with research around the edges of the topics that I'm involved in. It's part of my professional development. You can call it research if you like. It does bring in a little bit of business, but it's really about me learning and trying to discover and define a new type of financial advice I think that needs to be growing in the new type of world that seems to be evolving. Now, my weekly conversations with Rupert are always enjoyable, fantastic. It's really hard to actually to find people that are willing to have the kind of conversations that I need to have. So I find them super valuable. I know he values them as well, but the truth is the outcome isn't commensurate with the time that's currently being invested in it. I need a better return, or I need it to cost less time. So Rupert and I will be taking a couple of months off. There's a planning session already in the diary for August, and our hope is that by refining our processes with editing and production of the video content especially, we'll hopefully be able to provide much more value to you also in the process. And meanwhile, personally, I'm taking these time savings now and I'm applying them to the other areas in my business that are showing significant green shoots. So it may be a shock for some. I'm sorry about that, as it possibly was for poor old Rupert, but it's not all gloomy. Those who've been with me for a while know about my goal to reshape the future of financial advice. I can't do that when I'm going 100 miles an hour. I got to slow down occasionally and create some space for this. So I'm making progress though on it already, and I look forward to discussing what that means in a lot more detail soon. So in line with this, today's possibly not final News of the Money World episode is about technology. It's about AI, and it's about how it's going to change the way we invest. It's probably going to evolve from this and about how it's changing our lives, what it means to have wealth and build wealth and the culture, and eventually what it means to be human, which is really scary. So it's a fitting topic for what could be our final episode for now, and I hope you are finding it valuable. To stay updated with what's happening with news of the money world or anything else, please make sure that you're signed up to the Everyday Investor newsletter. The link is in the show notes. Let's get back to the show. And some of the key findings are as follows. The current cost of living crisis is impacting people's mental health. Okay. I can totally see that with almost everybody that I'm talking to at the moment. People are totally stressed out, and that's not surprising with inflation and with taxation via inflation as well, through the creep that occurs when you hit other tax brackets as soon as you get that pay rise that you've been looking for. Another finding is that Kiwis have finally become investors. Well, this is actually really encouraging, largely thanks to online investment platforms like Hatch and Sharesies and Invest Now. It's a lot more accessible, and the survey shows that 24% of investors have started investing over the past year. Now, that's really cool. Part of me wonders, well, is that actually due to just the euphoria and the media reinforcing these positive messages? And I know we would never confess to it, but it's pretty easy just to get caught up in the euphoria, and the fear of missing out kicks in. And next thing you know, you're an investor, but really you're actually a speculator. You know what I mean? And time will tell. And I think this year is the time that will tell whether or not, when things get tough, those investors slowly cash in what they've been investing, because they basically need to live and they haven't worked on some of the foundations yet. Actually, Rupert's just joined us here, so let's kick in with this one. Hey, Rupert, thanks for joining us again. I've just been reading out some of the findings in that report. So do you want to
Yeah.
maybe take us through some of those three key findings that I think to do with the cost of living crisis, Kiwis becoming investors?
Yeah. So look, from our perspective, what kind of when we look at is this sustainable? That's kind of one of the key things, right? Because fundamentally, we're like, have we finally turned New Zealand from a nation of property people into a nation of investors? and kind of moving people there. And to look at that, we wanted to look at three things, right? One is have people done well on their investing journey? So by that, I mean, if they actually made money, because if they're not making money, they're unlikely to come back. And I think here, what we were kind of pretty concerned and surprised at is 20% of people were pretty open. They've made losses on their investment journey. And then another kind of 20% turned around and said, we've actually got no idea. We don't know whether we're making money or not, which was kind of quite scary. Reminded me a lot of the gamblers who will be very quick to tell you when they've done really well. But the moment you ask them, do you reckon you make any money in gambling? Oh, probably, maybe. And it really indicates that people are not investing systematically. They're not being strategic about how they're investing. And that's what really concerns me, because we want this to be systematic, strategic, and an ongoing basis. The second thing that we looked at is actually how are people continuing to behave in the current environment. That one of the key things is to understand how do people behave when markets go south and when things get difficult. As Warren Buffett describes it, it's as simple as, so when people are scared, that's when you go hard, that's when you get investing. And when everyone is really confident and everything is easy, that's when you start to pull back. And that's because markets roll in cycles, markets always recover. And at the moment, the markets had a pretty tough year last year. And what we saw is that we saw about 25% of people actually significantly pull back on their investments. And the reasons for doing that were scared of losing money and scared of the uncertain environment. And that did give us cause concern, because particularly the people that have made losses, that by pulling back on their investments, what that's going to do, or pulling their investments out, that means they're not going to have a chance to recover. And so again, it comes back to the education piece. And so if we know people don't have a good experience in the early investments journey, then they won't come back. It's as simple as that. New Zealand has a generation of investors that were badly scarred through the 87 crash. And I think what we're really hopeful for, I mean, admittedly, the markets have been pretty kind to us over the last kind of 6 months, but we're really hopeful that investors, we don't get back into that same old trap.
Yeah. I find this fascinating. I'm just having a look at one of the graphs that you have on this report. How has your behavior changed due to the cost of living crisis? 45% of people say they're cutting down on spending. So almost half of the people out there are spending less. That is massive. If you think about that, 1 out of every 2 people are spending less. That will have downstream impacts everywhere you go. 42% suffering from higher stress. And this makes me kind of angry, because when I question where this all came from, you can trace it all the way back to March 2020 with the decision that central banks made back then, in my view. Inflation caused by government, full stop. 35% are investing less. Like, these are pretty grim details. Do you think that due to the time lag around rising interest rates, do you think that maybe we can finish up on this? Do you think that maybe one of the things that central bank government needs to sort of be mindful of is that their actions have significant downstream implications also? What are your thoughts on that?
Oh, massive. But I think there's a couple of things, right? The March 2020 stuff, in hindsight, was massively overdone. And again, the tendency of the central banks has been how to do everything in the world they can to avoid a crisis. In hindsight, you're 100% right. Potentially the world, New Zealand and everyday people would have been far better off if we hadn't gone anywhere near as extreme as we did. And that kind of puts us on this track of saying, hey, look, what's worse? A recession today, and kind of all of those impacts that you're seeing based on a pretty difficult cost of living, or significantly upping interest, which is kind of the interest rate world that we're in, or higher inflation. And so, look, I don't know what's the right answer, but we are in a mess. There's no question on it. And it's going to be really hard to get out of, right? The saddest thing of all over the last 3 years is that all of this money and all of this stuff that we've been pumping into the New Zealand economy, none of it's been used to improve productivity. None of it's been used to actually help out the long run, and that's the part that I find the saddest of all.
Absolutely, opportunity lost. And to end on a high note, we've only got 3 more months to go for winter, and maybe the next summer we'll have some sunshine. I don't know. That's all I can grasp. That's all I can get today in terms of positivity.
No. We can't be too negative though, right? I mean, you look at what's happening in the US right now. The US, the US economy keeps on pumping through. Recession keeps on being delayed. Maybe it's not even coming. We look here in New Zealand. I mean, at the end of the day, I think in New Zealand we're pretty negative at the moment, but the economic data stays pretty strong, and so we like to beat ourselves up and we like to think the world's ending, but the data doesn't tell us that.
Okay. All right. Well, you know what a fan of data I am, so we'll see. Okay, now that's it for this one, everyone. Thanks for listening in, and we didn't even get to some questions. We've got actually a couple of questions that hopefully we'll get to on a subsequent podcast. So thanks again, everyone, for listening in, and we'll catch you on the next one. Thanks, Rupert.
Thank you very, very much.
All right, cheers.